Hello, you're watching this video because you have heard about a thing called the 5 and 5 exception. 5 and 5 exception, what could that possibly be? Well, if you're thinking about a trust and if you're thinking about a charitable contribution, or if you're thinking about, I want to support my church or my charity, the Salvation Army Youth, whatever it is, you may be thinking about what's the 5 and 5 exception. So let's talk about it. Let's delve right in. 5 and 5 exception is talked about in section 514C to uppercase B. And in this situation, it talks about a charity. So someone wants to gift a piece of real property to a charity, but that piece of property is subject to a lien, a mortgage. That lien, in order to get that 5 and 5 exception, that person transferring the property need to, one, have held that property for 5 years, and that debt need to be on the property for at least 5 years. So you can't just get the property, slap on a big lien on it, give it to the charity, and then the charity can turn around and sell it. Because if you know anything that's going on in the back end, it's all about lowering taxes. I know you're not giving to your church in order to lower taxes, but it's one of the fringe benefits of being gracious and full of charity and giving to your church or to your charity. The rule that the IRS came up with is, okay, you want to give this property to the charity, that property has a lien on it, you have to hold it for 5 years. And then that debt needs to have been on that property for 5 years. And if that's the case, then you can give the piece of property to the charity, and that charity will not have to pay the unrelated business income tax. And that's because the IRS, they're no fool. They want to make sure that they get their taxes. Whether it's from you or the charity, they don't care. And therefore, in order to not put the kibosh on giving, in order to not cool it down, that exception is there. You can still have a piece of property. You can gift it to your charity. There's one caveat in there though. That charity cannot assume the debt. So there cannot be any obligation on the charity to pay that debt. They can pay the debt. They can send the monthly payment in order to maintain their ownership. So they get a nice lucrative 100 acres from Black Acre Trust, and they hold it and they pay the mortgage every month, and they sell it within the 10-year exception rule. So Black Acre owned the property for 5 years, they mortgaged it for 5 years, and then Black Acre gives the property to the charity, and the charity is paying the mortgage. The charity is not going to assume the debt, because if you assume the debt, you fall out of the exception and you have to pay that unrelated business tax. However, if Black Acre gives the charity the property and they meet the exception rule and the charity sells it within 10 years, no unrelated business income taxes, and the charity is free to sell, get that money, and do all the good things that our lovely charities do. My name again is Megan Truick, lead estate planning attorney here with the law office of Bryan Fagan, where we treat you like family. We really do, and sometimes even better. Thank you. If you just watched that video and you like it, please remember to click the like button. And most importantly, if you want to see more videos like this, go ahead and subscribe so that you can get the top of the line, most up-to-date information on our new posts. Thank you for watching.